So the next topic we'll talk about is value-based pricing, the best version, Stephen. And maybe you can just spend some time to describe that, and we'll talk about the advantages of it.
Great. So the critical thing about value-based pricing is to find a pricing metric that tracks a value metric.
This concept of value, I do a lot of writing, research, and lecturing on the concept of digital transformation, which in its ubiquitous term, a digital transformation is when you can identify real world challenges, and I'm referring to your customers' challenges for those on the webinar, and how you can use technology, in this case, SaaS technology, to make improvements or give opportunities for growth, create value. This has become a foundational aspect, I think, in value-based selling. It's so important to how you think about your go-to-market strategy. I find it fascinating how you can tie that back into the pricing concept. So I know, Stephen, you have some examples here how to make that be a little bit more clear.
Yeah, so let's go on to the next slide. So let's just define a couple of key terms first. So pricing metric is the unit of consumption for which a buyer pays. So, for example, you pay for gas by the price per gallon. The value metric, on the other hand, is the unit of consumption by which a user gets value. How far will that gallon of gas get you? And finding a pricing metric that tracks the value metric is really the key to successful pricing. So let's look at some examples. So back in the late 70s and early 80s, the jet engine manufacturers such as Rolls-Royce and General Electric had invested a lot of money in creating engines that were much lower maintenance and much easier to operate. But when they went around to the airline companies and tried to sell them these engines at a big premium, the airline companies were sort of skeptical. And they said, well, yeah, maybe, but how do we really know we are going to reduce our maintenance costs? How do we really know that these engines are going to operate more efficiently? And GE and Rolls-Royce had invested billions of dollars in developing these new engines. And if they couldn't get a significant price premium for them, it was going to be a really big problem. The solution, though, was to change how they sold the engines. So instead of selling an engine, they would lease an engine, and they would only charge for the amount of time the engine was actually being used to power an airplane. And as a result, they were able to get a lot more revenue per engine because they had shifted risk from the airline to themselves. And the reason they could do that is they had confidence in their analytics, in their knowledge of the engine, in their knowledge of how to operate and maintain it. And this not only saved Rolls-Royce and GE and basically destroyed Pratt and Whitney at the same time, it also created a whole new business model around leasing, which GE went on to build into a very, very large business unit. So let's look at a more software-centric example. So back in the day when the web was getting started, back in the 90s, web advertising was paid by impressions or eyeballs. How many eyeballs are going to see an advertisement? Now, just having an ad appear on the page is not a very good pricing metric because it doesn't really track value. Think of all of the things that pop up in your screen that you don't really notice. You know, as an advertiser, should you be paying for that? But if someone actually clicks on your ad, that shows that they noticed it and it was relevant to them enough for them to take a next step. So pay-per-click tracks value much, much better than impressions does and has basically completely replaced impressions as an advertising metric for anything that's online. And as a result, companies such as Google, but also Facebook, were able to win most of the advertising revenues online because they had a pricing metric that tracked value. Next slide. So another example of this is per user pricing. B2B SaaS is full of user-based pricing models. And I think the reason for that is that the first really big success in B2B SaaS, Salesforce, used user-based pricing. And many people thought if it's good enough for Salesforce, it's good enough for us. However, many applications are in areas where the number of users is not a good proxy for value. Again, looking at a healthcare scheduling provider that we worked with, they moved from a per doctor fee to a care path completion fee. Because what the health systems that they serve really care about are how many care paths get completed, because that's how the healthcare systems are getting paid. And this led to an increased average contract value of 20% and is expected to improve their net revenue retention by 5 to 10 percentage points. So, Paul.
Yeah, it feels to me like, I think it goes without saying that good go-to-market strategy, good sales tactics, you should know your value proposition for your target markets. So that hopefully is already common in how you go to market. Now you're just tying that back to the software and how can you capture that? So I think that's one of the key things is when you look back at your own platforms, where is that value being delivered to be able to capture that so that it can translate to these processes? Am I saying that back to you correctly, Stephen?
That's absolutely right. And one of the things that SaaS has changed is we now have a lot more data about how people are using our software. And if we design that properly and collect the right data, we not only have data about use, we have data about value. And tracking that value, that data about value, and sending it back to your customers can be transformative, not just in terms of pricing power, but customer success and reducing churn, and really giving you guidance on how you should innovate and where you should be driving your platforms and services.
I can see it. You go to do a renewal with a client, and if you can show that value, that conversation is going to go a lot easier.